Okay, today we're going to be going over the state of economy. We're going to be using boom, normal growth, and recession. So for our boom, our dividend is $1.20. For our stock price, it'll be 45, and for our HPR, it'll be 32%. You can see these are given once again. Just like the other problems, they are color coded. And then down here is the probability in between these. What you do is you take 1, you divide it by 3 since there's only like 3 sections. And then you're going to come down here to initial stock price and you're given $35. And then starting off to calculate for your expected return, what you do is you're going to take your 32% and you're going to multiply it by your first never-ending 0.333, and you're going to have those in parentheses, and then you're going to add that by the next row, and you're going to do that all the way down, which gives you 6.67%. Now for our variance, what we do here is we're going to take our 0.33, our first probability for boom. We're going to multiply it by our 32%, 8 holding period, and then we're going to subtract that by our 6.67% squared. And you're going to do that each time, like you just drop a row each time. So where we started off with this 0.333, now you start off with this one right here. And then you're going to multiply that by your 12%, and you're going to subtract your 6.67 again, and then you're going to square it, and then you're going to move down to this row, and you're going to do it for the 3 rows, and you get 0.05369. Now calculating for your standard deviation, all you do is take the square root of your variance, which you can just use the square root function in this scenario, which gives you 23.171. Now below we're given 50% was invested in business adventures, and then the other 50% was invested in treasury bills. What we do here is we take our 50% and multiply that by our 6.67%, which gives us 0.03333, and you do the same for this, except you're going to multiply this by your return on bills, since this is the percentage in treasury bills, which gives you 0.0200. And then our expected return is calculated by, you're going to take your first 50% and multiply that by your 6.67 expected return. So business adventures percentage times your expected return plus your percentage in treasury bills times your expected return on treasury bills, which gives you 5.3 to the infinity. And then for standard deviation, once again, it's going to be simple. All you do is you take your percentage in treasury bills and multiply that by your standard deviation, which gives you 11.585.